It feels strange to talk about Porsche, one of the most iconic names in automotive history, as if it's standing at a crossroads. But that is exactly where it is today. A brand once synonymous with luxury, precision engineering, and near-mythical demand is facing something most modern companies fear more than disruption: stagnation at scale. In late 2025, Porsche reported numbers that stunned Wall Street and shifted the narrative around the company's future. An operating loss of nearly €1 billion in a single quarter. That's not a small miss. It's a seismic reversal, the first quarterly loss since Porsche went public. For a company built on performance, exclusivity, and margin excellence, this is not just bad news. It's a warning sign. To understand why this matters, we have to strip away the brand mythology and look at the reality beneath the surface. Porsche is a business, and like every business, it lives or dies by its ability to sell products at a profit. For decades, it did exactly that, consistently, reliably, and with enviable margins compared to nearly every competitor. But the automotive industry is changing faster than almost any other at this scale, and Porsche is now confronting that change head-on. The headline figure, the €966 million operating loss, is the loudest signal that something has gone wrong. This isn't a temporary blip caused by a factory shutdown or a supply chain glitch. This loss reflects weak demand, poor pricing leverage, rising costs, and strategic missteps at a time when competitors are gaining ground. At the center of this storm is the shift toward electric vehicles. Porsche's current portfolio includes a mix of traditional internal combustion engines, hybrids, and a smaller lineup of fully electric models. On paper, this sounds balanced. In practice, it has left the company caught in a strategic squeeze. Customers who want electric luxury performance, the very buyers Porsche used to dominate, are increasingly choosing rivals whose EV strategies have been clearer or earlier. Tesla has been the poster child of this segment, but it's not alone. Audi, Mercedes-Benz, BMW, even Chinese startups are aggressively targeting this space with compelling EV offerings. Meanwhile, traditional combustion enthusiasts, Porsche's historical base, are holding back, not ready to switch, and are concerned about the price, range, and long-term value. The result? Sluggish sales where Porsche expected strength and weak EV demand where Porsche expected growth. It's a tension that has squeezed margins and eaten into profitability at precisely the moment when the company needs strong revenue power. What's even more concerning is that this isn't just a localized issue, it's global. In China, the world's largest automotive market and the epicenter of the EV revolution, Porsche has seen demand weaken sharply. Sales have lagged expectations, prompting the company to wind down its proprietary charging network there and scale back dealership operations. That's a rare and humbling adjustment for a premium brand. China was supposed to be Porsche's growth engine, and instead it's become one of its biggest structural challenges. Across Europe and the United States, the story isn't much better. Luxury automakers are competing for a shrinking pool of affluent consumers who are increasingly price-sensitive and selective about EV technology. Government incentives have shifted, economic uncertainty hangs over major markets, and consumers are not moving into electric vehicles at the pace many manufacturers had hoped. All of this converges to create a perfect storm for Porsche, a company squeezed between legacy expectations and future uncertainty. The loss itself speaks volumes. Operating losses are not simply revenue misses. They indicate that costs, from materials to production to marketing, are outstripping the income generated from sales. In Porsche's case, this is particularly visible in areas like battery technology, new EV platforms, and investments in charging infrastructure that have yet to deliver commercial payoff. But the broader story here is not just that Porsche lost money. It's that the market conditions that enabled Porsche's historic success are rapidly evolving, and Porsche's current strategy has not yet found a way to pivot with enough force or clarity to thrive. This is not a company in crisis. It is a company at a turning point, and what happens next will define its trajectory for years, if not decades. To understand the full gravity of this moment, it's useful to look beyond Porsche. The automotive industry as a whole is wrestling with the same forces. Underperforming EV demand in some segments, supply chain recalibration, shifting consumer preferences, and intense competition from legacy and emerging players alike. But not all companies are affected equally. Some, like Tesla, have carved out their identities around EV technology from the outset, while others, like Volkswagen, have taken a more aggressive multi-brand EV push. Still others are betting on hybrids as the pragmatic transition product. Porsche, in contrast, has been negotiating its identity between all of these poles, and that indecision is visible in its results. So when we talk about Porsche's operating loss, we're not simply talking about one bad quarter. We're talking about a strategic inflection point where the company's choices on products, markets, and investments will determine whether it can reclaim growth or continue to lag behind. Because at the end of the day, this is not just the story of a brand. It's the story of an industry in transition, and the choices that decide winners from also-rans. Turning around a company like Porsche is no small task. This is not about quick fixes or surface-level adjustments. It's about confronting uncomfortable truths and making bold, strategic choices in an environment that is anything but forgiving. The first thing Porsche must do is clarify its EV strategy. Hybrid models and internal combustion engines have been a bridge, but the bridge is showing cracks. The market is moving, and competitors with clear, aggressive EV roadmaps are capturing attention and revenue. For Porsche, this means committing decisively to electric performance vehicles that align with the brand's identity while ensuring that production, distribution, and technology investments are fully optimized. Delays or half measures will continue to erode both profitability and market perception. Next, market-specific adjustments are critical. China, once the crown jewel of Porsche's expansion strategy, has proven difficult. To regain momentum, Porsche cannot simply cut back, it must recalibrate. This involves re-evaluating pricing, creating localized offerings that resonate with Chinese consumers, and strengthening partnerships with dealers and infrastructure providers. The European and US markets also demand attention, but lessons learned in China can inform strategies globally, particularly around consumer expectations and charging networks. Cost management cannot be ignored. Investments in EV infrastructure, technology, and battery production are essential, but unchecked spending during a period of weak demand accelerates losses. Porsche must balance investment with discipline, trimming projects that fail to generate near-term returns and reallocating resources to initiatives with the highest impact. Operational efficiency, from manufacturing to logistics, will define whether the company can survive the current downturn without sacrificing long-term competitiveness. This scenario is not unique to Porsche. The broader automotive industry is feeling similar pressures. Other luxury and legacy automakers, including Mercedes-Benz, BMW, and even Volkswagen, are grappling with slower-than-expected EV adoption, changing incentives, and the challenge of maintaining profit margins while investing heavily in electrification. Even Tesla, long seen as the uncontested leader in EVs, faces demand fluctuations and pricing pressures that signal no market participant is immune. Consumers, meanwhile, are at the center of this disruption. Purchasing behavior has shifted dramatically. Many are cautious about high-ticket EV purchases due to economic uncertainty, total cost of ownership concerns, and evolving government policies. The reality is that demand is not matching supply projections, which places enormous pressure on automakers to adjust quickly or risk both financial and reputational damage. For Porsche, the stakes are particularly high because brand perception is entwined with financial performance. A company that once symbolized precision, performance, and desirability cannot afford prolonged misalignment between its products and consumer expectations. Recovery requires not just new vehicles, but messaging, experience, and alignment that assures buyers Porsche remains the definitive luxury performance choice, even in a fully electrified market. So what might the turnaround look like in practical terms? Expect sharper product segmentation, with EV offerings that target high-margin niches first, before moving to broader production. Expect a focus on operational efficiency and cost containment without eroding the luxury experience. And expect more aggressive marketing campaigns aimed at reclaiming mindshare in China, the US, and Europe simultaneously, a challenging but necessary endeavor to stabilize revenue streams. The lessons extend beyond Porsche itself. The automotive industry is being tested in ways few could have anticipated a decade ago. Shifts in consumer behavior, regulatory environments, and technology adoption rates are redefining what it takes to succeed. Companies that navigate these changes effectively will thrive. Those that hesitate will falter, regardless of brand legacy or past success. For observers, investors, and consumers, the implications are clear. Understanding the interplay between EV adoption, production strategy, and global market demand is essential for making informed decisions. Whether that's buying a vehicle, investing in an automaker, or analyzing industry trends. The story of Porsche in 2025 is not an isolated cautionary tale. It's a lens into the broader realities of the automotive world today. Ultimately, Porsche's current situation serves as both warning and opportunity. The company has the resources, brand equity, and technical expertise to rebound, but only if it embraces decisive action, navigates global market complexity, and commits fully to a strategic path that reflects the realities of the 2025 automotive landscape. Success is far from guaranteed, but for those watching closely, the next chapters will be as instructive as they are dramatic. The operating loss, the faltering demand, and the strategic crossroads are not just financial footnotes. They are markers of an industry in flux, and a reminder that even the most revered brands must evolve or risk being left behind. Porsche's story is unfolding now, and how it responds will define not just the company, but set the tone for luxury automotive strategy across the globe for years to come. Would you really buy an EV today, and would you trust one from Porsche?